Hi everybody, welcome back to the 10th of an Hour with Griffin Bridgers. For today's episode, episode 81, we're going to dig a little bit into the child tax credit, and we're going to look at how that was recently changed a tiny bit with the Tax Cuts and Jobs Act and with some new clarifying regulations which were just published in Treasury Decision 9913. And really what we're going to focus on are code sections 24 and 152 and the new regulations that supplement those specific code sections. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, before and after the Tax Cuts and Jobs Act, there is a child tax credit available for each qualifying child who has not attained the age of 17 at the close of the tax year. Now, prior to the Tax Cuts and Jobs Act, that credit was $1,000 per child, and then there was a phase-out of $50 for every $1,000 in adjusted gross income over some thresholds, $110,000 joint and $75,000 single. Now, this credit was in addition to what you could claim pre-Tax Cuts and Jobs Act, and that was the personal exemption. But as you may know, the personal exemption was reduced to zero, at least for the 2018 through 2025 time horizon of the Tax Cuts and Jobs Act. And as a result, you have a higher child tax credit available. So this credit increased to $2,000 per qualifying child post Tax Cuts and Jobs Act, and the phase-out thresholds were increased now to $400,000 for joint filers and $200,000 for single filers. Now, this is a credit that's reported on line 13A of the Form 1040. We're not going to really discuss the calculations and limitations around whether and to what extent this credit can be refundable. Just for reference, refundable means that if your tax liability is reduced below zero by the credit, can you get the unused portion refunded to you by the IRS? So that's its own separate discussion, but what I really want to get into is some clarification we have now around an extension of the credit to a qualifying relative. So one thing that the Tax Cuts and Jobs Act added is that the credit can be increased by $500 for each dependent of the taxpayer. So a dependent would be somebody other than a qualifying child who we're looking at here. So the dependent definition is under Code Section 152. And in particular, what the regs are dealing with here is the definition of a qualifying relative. Now, there's a family definition we're not going to get into, which is pretty broad-reaching. Now, there's some income requirements that do have to be met. One is that the taxpayer who's claiming the credit has to provide over one-half of the support of that qualifying relative for the year, and that qualifying relative's income has to be below the personal exemption amount for the year. But wait, if the personal exemption amount was reduced to zero as a result of the Tax Cuts and Jobs Act, then how can one really have a qualifying relative unless that person makes no income in order to be eligible for this credit? That could result in a lot of gamesmanship and shifting of income and other issues. But we now have clarification. Treasury Decision 9913 published new regulations under Code Section 24 and under Code Section 152. And what those regs clarified is that even though the personal exemption is zero through the end of 2025, the amount it would have been in 2018, if not for the Tax Cuts and Jobs Act, would have been $4,150. So that amount is the base for calculating inflation adjustments every year. So that $4,150 is going to keep going up through the pendency of the Tax Cuts and Jobs Act. So what this does is it makes clear that a qualifying relative can still have income cross-referenced to this personal exemption amount. So you're no longer referencing a zero amount, you're referencing what the personal exemption would have been if not for the Tax Cuts and Jobs Act. Now, as a result, this additional credit is allowed to a qualifying relative who can have income up to a certain threshold, and for 2021, that amount is $4,300. Now, there's a few other tidbits out of the new regulations. There's a clarification that a former spouse cannot be a qualifying relative. And really, in that light, what it means is that alimony or separate maintenance can't be treated as a payment for the support of any dependent, except to the extent that a portion of that alimony or separate maintenance is treated as child support. So what this does is it prevents alimony or separate maintenance, which are no longer deductible for income tax purposes. It keeps those from being converted somehow into this qualifying relative credit in order to game the system and get some sort of tax benefit for alimony or separate maintenance. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.